All right. Welcome everyone to Let's Talk Markets Live on this beautiful June 11th, depending on where you're at, I suppose. Really thrilled to welcome back to the program Ophir Gottlieb and Claudia Sam. Ophir with Capital Markets Laboratory, Claudia, the Bloomberg opinion columnist, and still running the consultancy, Claudia? Or no?
Yes, and chief economist at New Century Advisors.
Yep, that's right.
I stay busy.
Yes, stays busy. Thank you both so much again for joining us and lending your insights and perspectives as we talk about macroeconomics and markets. It's a real privilege to have you guys on the show every few months to catch up, but it feels like every few months we live through about 10 years of headlines. There's so much going on right now. Trade talks with China in London, the big beautiful bill, and a staggering market rally. Could you have possibly thought post-Liberation Day that we would be sitting here at the highs of the year and up over 20% from the lows on the S&P and almost 29% on the NASDAQ? It is wild what this market can just plow its way through.
Yeah, I would not have, but given the information on April 3rd, when's the last time we spoke? April 3rd, maybe? Something like that.
Yeah, that was right after Liberation Day.
Yeah, so given that information, the market would not have been at all-time highs. So what is that? I think it was Ed Yardeni. He said, I reserve the right to change my opinion as many times as the President of the United States.
That's a good one, yeah.
So, not on April 3rd, no. But here we are.
Yeah, so, going back to that, we talked right after Liberation Day. We were all, pretty concerned about the policy approach. The markets had, quite a crash at the time. And, now we're looking back and it's like it never happened. It was a dream. Let's talk about that. I mean, you think it's just because of these changing policies, changing perspectives, maybe the taco trade, the idea that Trump threatens but doesn't tend to follow through on many of those threats. What have been the impacts of the tariffs so far? Have we seen that start to crop up in the data, or are we still a bit lagged, and maybe we'll have to wait until this quarter's data comes out to really catch up on that?
So we're really just at the forefront of seeing the effects of the tariff policies. Frankly, the many different policies that have come out of this administration, whether it's immigration, the federal government downsizing, but of course tariffs loom very large. And this morning we got the consumer price index for May and
looked pretty good.
It looked pretty good.
Yeah.
I mean, like if tariffs were banned from the dictionary, which I think would be great, we would have looked at this and been like, this is excellent. I mean, there was some softness one might be concerned about in some, discretionary categories, but in general, this is what we've been looking for. The disinflationary forces continue to move along, and we really didn't see much of anything. I mean, there are some signs in the goods inflation outside of motor vehicles where you can see things starting to percolate up, and frankly, it's too soon to say coast is clear, tariffs, wherever they're going to go, they're not showing up in consumer prices. Like we're just like, that's not the right conclusion to draw from today's data, but both the inflation data and then last week we got a lot of information about the labor market, and there too the effects look pretty gradual. There's some cooling, but it's really pretty slow. So I mean, this would be ideal. Unfortunately, like we're just at the beginning phase, so it's too soon to say what the economic reaction will be. But we can already tell it looks different in terms of its timing and its shape than say the markets back in April. Right. Yes. Just like the things really drop dramatic. Now, a $30 trillion economy does not turn on a dime unless something really explosive happens. So it's not maybe so surprising. And I think it's a little hard to read the economy right now because we had a lot of behavior kind of trying to front run the tariffs. And then those effects. So like, as you go through that period, it gets really hard to read things because, you know, you're pulling forward and backward demand and like prices and there's a lot of uncertainty. But yeah, in general, the real world economic effects are pretty mild.
I'll say this: we had a super interesting program 2 weeks ago. We had someone from a trucking logistics financing company come on, and his point was that when all of it came down, like the Liberation Day tariffs, there was tremendous amount of uncertainty and fear in everyone that he spoke with, and yet none of that has seemed to materialize. That he doesn't see any risk of bare shelves, for example. They've seen a mild slowdown, but nothing that would be really concerning. And he was expressed surprise at sort of the resilience of supply chains and trucking right now, which to me sort of ran counter to the narrative that I had been hearing, which is that the ports are drying up and trucking is going to be, affected dramatically, and we're going to be seeing very soon, the summer bare shelves at the stores. Yeah,
I would also say, and I'm a big fan of the media, so what I'm going to say is going to sound like I'm not, but I just want to be clear. I actually am very big fan of the media. It kind of makes the country safe if you think about it, like beyond politics. Like if something really terrible is happening too, and it feels institutional, like the media is actually something that can protect you. Having said that, way overdone. Yeah. They were just the reason you and I and Claudia, reason we know Claudia's better connected. You and I, Dave, the reason we know about possibility of bare shelves and things like that is because that's what we were told.
Correct.
And granted, it was by some very important CEOs. So I'm not saying they were just pulling fiction. I don't mean to say, but like, it's just not true. Now, again, I don't know. Maybe in 2 months we get together and I'm like, oh, see, empty shelves. I don't know. But it just like we have ever since the invention of, not to give a history lesson, the invention of the cable news network. Ted Turner, first person who was like, we can make money on this, where the broadcast channels did not sell commercials on the news, and that ended. It's always been more sensationalized, and that's okay because they still cover great stuff and they have great analysis, but like, man, it's been really, really heightened in the last month or two where it's just like, it's just outright wrong. And so, yeah, I think a part of I'll speak for myself, part of my shock about how things have not fallen apart is like how much I was relying on that. So,
yeah, I feel the same way.
Yeah, although it is worth pointing out that in the time intervening from our last conversation, I mean the tariff rates have come down completely, right? A lot of the and I think this is I'm not sure I would place all of the blame with the media. We have a policy making process that's going right now that's all about bringing on attention. I think is the nicest way I can say it. So there were just a lot of, we had the Liberation Day tariff where all of a sudden it's like, we're tariffing penguins and these are big numbers and we're covering allies. Like it just, and then we're going to walk that back, but we're going to go to astronomical highs with China, like numbers that just don't like that would shut down trade. And so then there's a discussion about the shelves will be bare. And it's like, oh no, we're not going to do those rates. We're going to do much more, I think that the tariff rates right now, they are notably higher than they were at the beginning of the year, but they're of a more, like they're in kind of a manageable range. Like we don't have anything that ought to like really shut down trade. And, understanding that imported goods, this is definitely a cost factor for some businesses and it's a piece of the economy, but this isn't like, we're not this massive, it's a hit, but it's not a catastrophic hit to the economy. Right. So we went on like a roller coaster in terms of tariff rates and even where we're at right now, though they are much more modest. Again, they're 6 times what they were before the year started. And like they're outside of living memory in terms of the amounts, and everything is moving at light speed. So, yeah,
I would say there was the shock of the actual announcements on Liberation Day, which were nothing short of shocking. evoked a proper response from the media, which is like any big words, right? Just profound superlatives. I think by around the third week of April, I think it was reasonable to be like, okay, we don't know where we're going, and it could be bad, but it's almost certainly not going to be whatever it was on April 20th. If you're doing the news on April 20th, it's almost certainly not going to be what it is today. And that's what was missing. I believe the initial impulse was absolutely appropriate. I don't think you could have overdone the initial impulse. It was very, very bad. Anyway, it's a silly conversation. Also, yeah, so Claudia's right. There is Ernie Tedeschi's follows like this. Like there's also Professor Harvard who follows imported goods inflation, and actually it's kind of fairly linearly up. I mean, it's happening now. It's like 9% of 9% of the economy, but like yes, there is inflation from tariffs. I mean, it's tariff-driven inflation. There is.
Yeah, I can tell you, I mean, here in Canada, again, like the reaction from the start, which was obviously before Liberation Day, has been dramatic in terms of how people viewed what the economic impacts of US policy was going to be. And yet, you know, with people calling for a dramatic Canadian recession and potentially worse, and the need for the government to step in and support those affected. And yet that hasn't materialized either. The Canadian economy has remained very resilient, very strong. And I think people here are pretty shocked at that, without realizing that, again, like that initial impulse, the initial threats were dialed back dramatically, that the ultimate tariffs that were actually levied have been far smaller than what was feared, but still, you know, not immaterial. And you see it in some places, but also there have been dramatic substitution effects up here.
I imagine.
Right. Yeah. You know, no one is, I mean, the anti-Americanism is very strong. And I think you're seeing that. So I think there is going to be damage from that perspective. But again, you know, how that impacts the US, hard to say that it's actually material in this grand economic scope of things. But let's talk about what might be material. It seems like, according to the trade deal maker in chief, we have a deal with China. What do you guys? You know, I saw he posted about it. And
what did he post?
Oh, he posted on Truth Social, and
how long ago?
Earlier today. And
see what happens when I work for 2 hours.
Yeah, you don't even see it. Actually don't have it in front of me, but if I remember, it was something. He said the trade deal was China would go down to 10% tariffs. US would remain at 50%, I think, or 55%. I don't remember the exact number.
Yeah.
And that there would be no problem with rare earth metals.
That I saw, the rare earth
and
metals.
Other critical minerals. Although then it came out that the Chinese permits for that would only last 6 months. So the details are continuing to sort of like come out and get fleshed out. But you know, I guess Claudia, what was your initial reaction to that post?
Yeah, my reaction to today's news was, I think, pretty close to the markets, which they just kind of shrugged it off. And I think it was Lutnick or someone had described it as, you know, they have a framework to implement the agreements in Geneva. And I'm like, well, shouldn't you have had that when you left Geneva? I mean, like, so it doesn't feel like there was actually a step forward here. And, you know, I'm in kind of thinking about CPI today, and like the discussion about the rare earths and these, like, if we have disruptions to production in the United States and like the automobile industry, I mean, automobile and related industries are still shaking off some of the disruptions that you can go back to 2020 with. So, and I don't think, you know, what we're talking about here is probably not in the scope of that, but to, you know, switch in rare earths for semiconductor. And if you have any kind of shortages, even if the effects aren't as dramatic, it's like you're just setting off a whole other chain of events. So it's good to see that this has been a focus. And like, I think the administration seems to be more aware of where some of the pain points are than when they kicked off this whole, which is an unfortunate sequencing. You'd want to do that first.
Yeah.
But there is an awareness of where like some real pressure points could be, but it's just I didn't take a lot of comfort that this has been resolved in any way. So
I would say my comfort, because I saw the rare earth metals thing. I think the comfort I would take is simply that we're not, for now, we're not, as of 10:18 a.m. Pacific time, we're not reverting to, kind of the other path, the threats and the escalations. And so like that, I take some comfort in that. Since it sounds like there were no real facts shared, then hard to take any real solace in the deal points. I think we can also tell, which I don't think was obvious. I'll speak for myself. Wasn't obvious to me on Liberation Day. It does seem like the president of the United States does want to actually make deals, and he doesn't just want to impose tariffs. And like it's not a means to an end. That was the end in itself. So that's different, right? If the end in itself was just have tariffs, then there's just not a whole lot. Well, that's what the market said on April 2nd, right? Like, well, if he just wants tariffs, then yeah, we're going down 50% and the economy is going to recession. That's it. And so it doesn't seem like that's the goal for now.
So the professed goal with China, at least, that Secretary Bessent said, was that we are not trying to decouple.
That's right. He was very specific about what he wanted to do. Yeah.
Correct. That is not the professed goal of, let's call it, the J.D. Vance wing of the current Republican Party, and supposedly wasn't of Trump, but now maybe is. Yet, what Trump says, now I have it up, a total of 55% tariffs. That's pretty significant for Chinese trade. It's not 145% for sure.
55% is a huge number.
They had the White House clarified, because people were like 55. Wait, did you just raise the tariffs? But the comment is going into this, we already had 25% tariffs on China. And then in this administration, we're now up like the 20% from the fentanyl and then the 10% of the all country reciprocal. So that's where that 55 comes from.
Got it. Okay. I didn't see that.
Again, this is like doing major policy by social media posts has some downsides. Who would have thought? But yes, it isn't we're not up in triple digits. And I agree. I think it's good. The tone has shifted and it doesn't seem as threatening as it had been earlier.
There's also real fear that it's going to sound ridiculous when the taco trade thing came out, that Trump was going to go on some bender,
sure.
And it just, I don't know if I can say credit to him for not overreacting as a president, the leader of the free world, but as a leader of the free world, he was like, all right, he scolded that reporter, it's like, always kill the messenger, it seems like. But other than that, I don't know. We didn't see what certainly could have happened.
Yeah. So what do you think of 55%? Like, what kind of economic and inflationary effects would we expect to see from a 55% Chinese tariff?
So an additional 30%.
In addition, right. So the 25% was from his first term. It was maintained by the Biden administration. So now we're talking about, slightly more than doubling that.
I'll let Claudia go. I have an opinion too, though.
Yeah, it ought to continue the process of businesses looking for supply chains that are outside of China. The way the reciprocal tariffs, particularly that they're kind of set at the 10%, you still have other Southeast Asian countries that are, potentially substitutes for it. So you'll continue to see that substitution away from China, which we had seen, after the first round of the tariffs. I think the other thing that's kind of interesting that's probably reshuffling some business in China is the fact that the administration dropped the de minimis exemption. So a lot of the businesses have been using the fact that it was small dollar, or relatively small dollar imports were tariff free, like that's been dropped. So they went into a full tariff regime. So that, again, it's a lot of the kind of substitution effects, but it's just, we've seen with some, and again, early days in terms of how economies are reacting, but the Chinese exports to the United States seem to have in the most recent data dropped off some, but then they had increase in exports to other countries. So like how much, I mean, this is just what's really fascinating is watching, I mean, businesses, consumers, like everybody's trying to adjust to this. And we would really rather keep on the onward and upward path. There's this extra set of costs that there's lots of different places those tariff costs can go. It's just this kind of, how can you adjust to it? How do you like kind of navigate through it? And you know, it's really hard to say where this goes, especially the policies still are pretty fluid.
Yeah.
In terms of where this is going to settle. And honestly, at this point, watching, I really think we're in for 4 years of this. I don't think tariffs are going away. I think there is a real desire to negotiate and kind of like have surprises. And we've got the countries, we've got the sectoral tariffs. I mean, this could just like, it could be at this for quite some time. And just learning to live with the uncertainty of it.
I agree. I think that the tariffs on China, if the goal is to make supply chains move at least somewhat outside of China, but not necessarily to the United States, then the administration is kind of punching itself in the face by these other, what they're calling reciprocal tariffs on adjacent countries, which would fulfill some of that, like Vietnam. We'll see where that goes, because those haven't been settled. Also, the removal of the de minimis exemption, which just means goods less than $800 were exempt from tariffs, and now they're not. That's like in the e-commerce world, that's like earth-shatteringly bad. That is their earthquake, just the taking away of the de minimis. Now, depending on what level is levied on those, but that they were at zero, and that I speak to CEOs about this, and that's like, but both CEOs of small SMBs, like 12-person businesses, and also of public companies of multi-billion-dollar businesses, and that has immediately had changes in the way companies are locating where things are from and where they're selling and how they're importing and how they act as a vendor of record. It's that immediate action has been taken. It has not been delayed. It was like one day, things are changing. So, and we don't know what that means, as Claudia said, but they are not waiting.
So is that policy, but that policy is not yet effective?
I don't know, but they're acting as though it is. I don't actually. Yeah, it has companies. So think of a really large retailer. I don't know. I don't want to say name because people are going to think I'm talking about the name. A big clothing company, right? Big. And they make a lot of stuff in China, and then they sell it from their China factory to the US or to Canada or to and all of a sudden, if there's the de minimis tax, and most of these orders are under $800, so it's just not a big deal, right? It's B2C, business to consumer. Once that's taken away, they are sort of discombobulated and disentangling everything that has to China. They're putting inventory holding spots in Vietnam or in other countries, so that so you only have to pay tariffs on the wholesale price. I mean, everything is getting disrupted, and there are new rules and new laws, and do you pay the tariff on the retail cost or the wholesale cost, or the wholesale cost before the wholesale cost? What if it's B to B to B to C? And this is all happening. They're not waiting, and they're figuring it out on the fly. And when this settles, it will have an impact. Things will be more expensive. Those things.
Now, to be fair, my understanding is, from a national security perspective, the elimination of the de minimis exemption is a really important thing. That this was a really material source of fentanyl flowing from China into the U.S.
I wasn't true, or probably true. It wasn't a criticism. I just wanted to let you know that there are some things, like Claudia saying, spot on. Is we just don't some companies still haven't acted. I'm telling you, in the e-commerce world, they've acted very, very quickly and decisively. Very quickly and decisively, instantaneously. They're taking it as though this is it. This is the law. This is what it is. De minimis is gone. We got to change it.
Because when the original China tariffs had come into place, and they did talk about, and the fentanyl tariffs, and they did talk about getting rid of the de minimis exemption, and then they didn't do it. It really did call into question how serious they were, and how seriously tied the tariffs were to the fentanyl issue.
Yeah.
Certainly from that perspective, to me, it's a good thing, but it's very disruptive.
By the way, disruptive doesn't mean terrible. I'm just letting you know that in this space, companies are moving quickly and decisively. It's a little bit less of the let's wait and see. Actually, I'm hearing nothing that's wait and see.
Yeah, well, and I would also say that initial, like, we're going to drop the de minimis exemption. Oh, but wait, we have to a lot of that was that the administration was moving so quickly that the infrastructure needed, I mean, like the post office, like, what are we going to do? Like, we can't handle these packages. So it was just, there have been real this is having a policy that moves so rapidly, and the president has chosen to do his major policies through executive order.
That's right.
And ones that are allowed and use emergency designations to move more quickly. There are other, the courts now challenging the use of the International Economic Emergency Powers Act. There are other paths that the president could take to enact the exact same suite of tariffs, but most of these other paths would likely take more time because there's investigations, there's some kind of back and forth with the countries or the businesses, or some that are more broad-based would, after a short period of time have to involve Congress, right? Like, so there, like, he could go these different ways to get the same tariffs, but by choosing to go through these kind of emergency economic powers, it really pushed the system to be even processing. It's actually kind of surprising looking at like daily treasury statements. The collections for tariffs don't quite, I mean, they're like half of what the effective tariff rate should be. So it's clear. I mean, it's not that, like, it's probably just that, there were exemptions if the boat wasn't, had left China but wasn't here and we wouldn't charge it. And then, companies have got to actually like pay the taxes. And there's been use of these like bonded warehouses. Like, there's all kinds of ways to try to like delay these costs because they came out of like nowhere practically, particularly in the specifics and the magnitudes. So I think you've just seen, and it's not just with the tariff policy, but there's a lot of pressure on the whole system. And a lot, I mean, for businesses have been trying to navigate this. It's kind of outrageous, really.
I mean, I guess I can't say it's surprising that Congress doesn't seem to feel the need to reassert its authority to levy tariffs. And yet, that's what the Constitution says. That certainly would be a more deliberative process and would be less risky if you are the administration levying tariffs under, auspices that are being challenged, and very reasonably so, in the courts. I mean, it's hard to justify that we're in an emergency now when it's been a multi-decade trend under, nearly every previous administration. But we'll see, because,
a part of the executive order thing, Dave, also is that because it's executive order, he can change his mind every day. Which if it's passed through Congress or any apparatus, even if it's like faux Congress, like not quite, you can't go 134%, 50%, 25%, 50%, 25%, 134%, 0. You can't, right? So it would really, yes, these tariffs could go through, right? The way they should, but this kind of discombobulation or negotiation maybe just would be impossible. I mean, can you imagine going to Congress several times?
No, especially this Congress, which, really.
I mean, honestly, Dave, any
do
Congress.
Anything. It's fair.
Every day. Come on.
We did have a trade deal, right? We had a UK trade deal.
Yeah.
Was it
because we had a surplus?
Yeah. What do you make of the UK trade deal? Was it anything to talk about? I'm not versed enough on the deal itself or the previous state of U.S. UK trade to talk, thoughtfully about it. But maybe one of you are.
As far as I understood it, we used our reciprocal tariff, which was just 10%, and that was it. I think we have a trade surplus with them. So that was the conversation.
Yeah, no, it wasn't a formal deal. It was kind of, here's the parameters, the framework of it. And I think it's one where if that had kicked off a succession of deals, like it's like, this is kind of like starting with some low-hanging fruit, not a lot of tension here. Again, you have the trade surplus. There were some very specific, like, non-trade barrier issues that were kind of being discussed. And it was a good case to see that, I mean, it does appear that the administration, to the extent that it is about anything, it seems to be serious about this 10% tariff baseline. So kind of watching how it negotiated, like, around tariff rates and whether that was kind of a floor or was something that was under negotiation as well. That was, somewhat interesting, but like that wasn't the start of a whole succession of trade frameworks or deals. And, again, the what is it, July 9th?
Yeah.
Is when for all of these many countries, it's supposed to come back up again. So, and I don't know at this point with it being under, the trade court saying that they've, the president can't use these emergency powers and, but they are still, the higher courts have said you can continue to collect the tariffs, while the, appeal is pending. Like who's going to negotiate with the United States?
Mm-hmm.
Like this is just, this seems very in flux and the administration seems to have, their attention's really gotten taken with China more recently, which I think probably, it seems that's the country that we should have been having the negotiations with and the tariffs and like this, everything else seems to be a big distraction, a costly distraction.
Costly, yeah. So what looking into your Trump Truth Social crystal ball, do we get a further delay in July, or do you think it actually?
I think the pain trade is higher. Pain trade for the market is higher. The pain trade is higher. It's just, I think, I don't know where this settles. It would be ridiculous if I said it, but I just think we're going to get drips and drabs of, or more of good news, like today with China, which could have been a big market mover, wasn't. Right. I think the pain trade is higher because of this. I think for all intents and purposes, the news coming out about tariffs will be considered good or not bad from here forward. Of course, there could be egg on my face if there's a disaster on July 10th and we go down 30%. But
sure,
but
the market feels like it's pricing in.
If you're positioning for the market right now, then you can't be short right now. It's just the pain trade is higher. Everything you bought, you're going to wish you bought more. Everything you sold, you're going to think you're an idiot, and everything that you bought some of, everything you own, you're going to wish you want more. Everything you sold, you're going to feel like an idiot. Everything that you were going to buy, you're going to kick yourself, and then you're going to chase it. And like the pain trade is higher for a while, probably because of this news. Like these drips and drabs, or maybe there will be more than drips and drabs. Where it all ends up, boy, I don't know.
So your feeling is, at least right now, it doesn't look like a bull trap.
Well, when the pain trade is higher, it is a little bit of a bull trap because but I feel fairly strongly that I don't think the pain trade is lower. Lower is, there are too many people expecting lower, too many people waiting for the bottom to fall out with really good reason. I'm not casting aspersions at all. Like if you just objectively just read the facts, it's like, this isn't good or could not be good. But no, the pain trade is higher. People want in, they're chasing. And I think it's going to be bolstered by news like today, stuff like today. So the really long answer to what I think is going to happen July 9th is, I don't think we're going to fall off a cliff on July 9th. Could be dead wrong, but it just doesn't feel like that. I do think near the end of summer, that pain trade is going to go away, and then we're going to start going lower.
And that could be when, regardless of what happens going forward, we will be seeing clearly what some of the economic effects of these policies are.
There's going to be, I don't know if anyone, Claudia, I'd love to know what you think. I don't know if you feel like the Fed feels pressure from a president so directly attacking what the Fed should, right? But if the Fed feels pressure, it ain't seen nothing yet. So, and again, maybe that doesn't matter. We are going to have a new chairman with, anyway, but that pressure is going to really, really, really escalate. It's already escalating to the point of like absurdity, but I think it's like the first inning of a 9-inning game, and it's going to get super intense.
Yeah. So let's talk about that. Coming into this year, I remember right, it was something like 3 to 4 cuts were expected. Now we're looking at maybe, the markets at least are saying maybe September, likely September, but that feels like, I don't know how much information is in that, because it simply just keeps getting pushed back. So what, Claudia, what's the Fed thinking right now? What are the, what kind of forecasts are they able to look at to try and understand better what some of these economic effects are going to be, and how do you think they're going to approach the next few months?
Yeah, so first, it'll be pretty interesting next week when the Fed meets. So they're not going to cut, despite the president's encouragement. But they are going to reissue their summary of economic projections. So while not a consensus forecast, not something that like speaks for the FOMC as a whole, we do get a picture of what the individuals on the FOMC think about. I mean, the answer to your very question.
Mm-hmm.
And the last time they did their forecast was in March, so it was before Liberation Day. So, but we had a sense that tariffs were going to be higher, and this was going to be a potential drag on the economy and a potential boost to inflation. So, and at that time, the typical or the median Fed official had 2 cuts for this year. And it was close to a knife edge. Like it was about 2 versus 1, like would have been where the median is. And then I think it'll be interesting to see how they process a labor market that is cooling, but very gradually, and inflation that is, I mean, core CPI was flat at 2.8% for 3 months through May. The core PC has shown some progress now. It's still elevated, 2.5% in the April reading, but not like if it weren't for the tariffs, the discussion next week would be lining up the next cut, and not like, oh, it could be September, October. It's like, oh, it could be like now or very soon.
Absolutely.
But there's enough uncertainty about what's going to happen with inflation, and there isn't this forcing because the labor market isn't deteriorating. Like
Right.
We're not seeing the inflation pick up, but we're not seeing the labor market deteriorate. And the labor market, 4.2% unemployment, that's basically got a full employment economy. Now, it may be headed in a direction that is somewhat worrisome, but then like inflation already is elevated and is headed in a direction over the near term that's potentially worrisome. So I think the Fed has good justification to kind of sit on its hands. But it is a very bizarre, I was kind of thinking about, like, it's such a change of fate of like, in 2021, they're like, oh, that inflation you see that picking up, it's going to be temporary. It's going to be transitory. Like we're watching it, but they're like, no, it's going to go away. Right. And now it's going to be like, we don't see it, but the inflation is coming, right? Like it's like the exact opposite of it. I mean, there's still, I think, yeah, so it will be a little bit tricky next week. I do think that to me, they're going to want to see some signs in the data that the tariff inflation is not substantial in size. And we may be getting some hints of that already. Like we're not seeing just huge adjustments in prices right out of the gate, and some kind of sign that it's temporary. Like some of the series that started to adjust their prices quickly, have they started to like hold and the inflation is starting to ebb? Like something that gives them this is transitory. I think they're really, unless things fall apart in the labor market, I think they're going to wait until they see some sign. That is going to take time, right? Like it's June. Like the end of the year, like the clock will run out. Like every month we get like a good read on this. Yeah. And so, but I still think they're in a place they could do 2 cuts before the end of the year, but like October and December, right? They'll be waiting a while. Now, on the question about how they deal with the pressure from the president, I honestly think at this point it's a bigger detriment to him, to the president, and to, in particular, who he chooses to replace Jay Powell, because this Fed is not going to listen. I mean, markets would go nuts if Powell came out next week and was like, "Oh, we're cutting by a percentage point." We heard the message loud and clear. I mean, and nuts in not a good way. Like So I think the pressure on the Fed is not going to be effective in getting the Fed to change its monetary policy decisions, but again, it's going to be it's really going to be hard to think that the Fed chair that comes in next is a credibly independent chair. I mean, I keep thinking if the president keeps this up, Jay Powell may be his only person to put in his chair to replace Jay Powell. Because who Bessent tacit war. It's really tough. I do think I think Waller could be a potentially very capable replacement, and he has made a credible case for inflation from tariffs as transitory. Like we would be cut, but even Waller is talking about waiting to see more data, building a case we could make cuts this year, later in the year. Like he's not in the like percentage point. So yeah, I find it a very distracting, unuseful back and forth.
I'll also say that Claudia said this before about how unfortunate that this is all happening. Like PCE is at 2.1%. That's what the Fed actually targets. Like we did it, man. Core is at 2.5. It's coming down. Like we fucking did it, man. You know, like okay, it wasn't transitory, fair. But
it looks like a soft landing right now.
A soft landing. We did cut 100 bips. Still at 4.2. I don't know, Claudia, if you feel like the SOM rule triggered, because I know if you round to a third decimal point.
It did trigger, but it had some labor supply issues. But yeah, but just barely.
If you took it to hundredths, it might not have, but it doesn't matter. You're definitely the decider on that, not me. But like we did it. Like we did it. Like it. And if it's, I don't know if we did anything. It happened. How about that? It happened. It got better. Yeah. And we don't even we can't celebrate it. We can't take there's no relief. Like that is such a shame because, oh my God, PCE is at 2.1%. Like that's it. We did it.
So at least on Kalshi right now, the consensus pick is Kevin Warsh, followed by Scott Bessent, followed by Waller. Just the market amongst them. I mean, Bessent seems like a risk. What about Warsh to the market?
Yes.
Yeah. Again, knowing the president, the criteria he has for people that work for him or with it, you do want someone who's going to come in as Fed chair and look at what's happening in the world, look at what the best information, and like make decisions, as opposed to I've been chosen because I will cut rates. Now, I will say, like, there's nothing like Warsh's public commentary does not have him like just mimicking what the president's saying. So it's not to, like, I'm not questioning individuals here. It's more of this, like, just the way there's been this politicization between the president telling the Fed chair what to do. And it also, like, it really misunderstands the institution
big time
as well.
For sure.
Also the impact of the Fed funds rate, just to be clear.
Well, yes, yeah, that too. But it'd be really unfortunate next year to have a vote of the FOMC where the chair is in the minority on the vote, or something ridiculous like that, right? Because it doesn't. Which it just be, it's not, the Fed is not run by one individual. I mean, and it does work by consensus, and it does deliberate in ways, and it has a dual. I mean, it has an inflation mandate as well. Independence is for a reason. So I don't know. It just makes things a lot messier. Like this is an incredibly hard period for any Fed to navigate when you have stagflationary impulses, at least ones that are potential of some, and then to have on top of that the political, not interference, but just like the drumbeat of questioning. So
also a lower Fed funds rate doesn't necessarily get the administration what they're actually asking for, which is a lower, longer term yield. That doesn't. I mean, you can make a very good argument right now that the 10-year yield wouldn't really move if the Fed funds rate went down 100 bips. It actually would put us closer to normal. It would actually be more equilibrium. So unless we're going to refund our debt every year,
Right, and there was quite a bit of speculation post Liberation Day in the midst of the market crash that Trump helped to fuel, that they were purposefully talking down the market, hoping to really impact the 10-year, that they thought there would be a flight to treasuries, as there tends to be when markets sell off. It had the opposite effect. That was really wild to watch it unfold in real time, and to see people not just fleeing the stock market, but fleeing treasuries as well.
And still now we've come down. The 10 years higher than it was at the start of the year, I believe.
Yeah.
Fed funds rate will impact other things like the prime rate, things like that, but it's not going to impact the cost to fund the U.S. debt again, unless we're issuing bills.
It's certainly an approach. All right, let's switch gears. Let's talk about the big, beautiful bill. How beautiful do you find this big, beautiful bill to be? I'll tell you, a survey from the National Federation of Independent Businesses found that small business owners are worried about the impact of this spending bill. 1,000-page legislative agenda, which includes $3.8 trillion of tax cuts, which primarily would benefit wealthier taxpayers, as Trump's previous tax cuts did. There's certainly some great things in there for average people, a 15% tax cut for working families, supposedly, increase the child tax credit, no tax on tips, no tax on overtime pay, which I don't think are in there yet, but supposedly the Senate will be putting in there. So I get it. We don't know the full shape of the ultimate bill. We don't know what the Medicaid cuts are going to look like. We don't know how the phase out of the IRA energy tax credits are going to look. But we do know the core, the centerpiece, deficit-fueled tax cuts, primarily for wealthy individuals. So let's start here. And Claudia, I imagine you can answer this. I hope you can, but what was the impact the first time that they did this? What was the impact on economic growth and government revenue, which Mike Johnson has been vociferous in saying that the SIBO is getting wrong and because it underestimated those impacts from the previous effort.
Mm-hmm. Yeah, so I mean, anytime we do macroeconomic policy, answering these kind of simple questions, what are the effect, is really difficult, right? Because we only live this world once, right? So we don't get to see the world without the tax cut and compared to the world with the tax cut. And that's always the case with macroeconomic policy, because it kind of turns on everywhere, and then there's always other things happening in the world, right? So kind of comparing before and after is also very fraught. The studies of the Tax Cut and Jobs Act in 2017 were particularly hamstrung by the fact that not that many years later, we had the pandemic that really scrambled the economy. Mm-hmm. So the studies that are done both kind of looking at the aggregate data and then also a lot of times they'll look at firm data, because the TJCA had several like corporate tax cuts as well as individual cuts. The short-term effects appear to be maybe a modest boost to growth, wages, some. If you look at some of the studies that looked at like businesses, kind of looking at micro data, so comparing across businesses that had access to the different, or the tax cuts applied to them or didn't, there was maybe a little more evidence that there were investment effects, right? Because we do want to think, it's like both the short term, we can kind of goose demand by putting more money in people's pockets, but then it's also this long-term growth, which is really where can it pay for itself? Can the tax cut pay for itself? You got to have that long-term growth. And a big piece of that could be, say, building, the capital stock and like through more investment, more savings, whatever. Mm-hmm. And there, the academic studies, a lot of the policy studies from places that are quite nonpartisan, I mean, the effects don't look like they pay for them, that the tax cut paid for themselves. And I think one thing that, as the analysis of the current big, beautiful bill has been done is this time around, even just from the policy itself, there may be less of a case to expect big growth effects, because some of the corporate expensing these are temporary tax cuts, they're not permanent. There's not as much tax cut corporate in this bill as there was in the first one. Like kind of strategically, the way the U.S. works is like if they go do this through reconciliation, they can't increase the deficit outside of the 10-year window. So then you have all these policies you put in place, but then you'll sunset them so you don't start creating deficits outside of. So in the original Trump tax bill, you had more of the business provisions got to keep going, whereas the household ones were all expiring in 2025, with of course the assumption that we'll extend them, right? And so that this piece right now, the big cost of the current bill, a big chunk of the cost is the extension of these household tax cuts from before. And again, it's harder. Those aren't the taxes that we would typically think of as being giving the big oomph to long-term growth. And just before you think about the growth effects, the kind of static scores of this current bill, I mean, they're increasing deficits. Right. So the increased deficits, they can push up interest rates, crowd out investment, right? So then that's working the opposite direction of the idea of it paying for itself with higher growth. So I don't think we've seen this in the past hold up. And I don't think even, now with the details of this bill, I think it's even more questionable, the idea that you get enough growth to, wipe out the extra deficits.
Yeah, I think the Trump administration has to really determine are they there to reduce deficits or not? This isn't reducing deficits. No, it sounds like
no. I don't think so at all. I think that's spot on. Right?
There are senators. I mean, we know them now. Some Republican senators who are kind of saying that they're like, wait, I mean, either we're here to be whatever fiscally responsible means to you. By the way, whatever. They're like, this isn't it, which I think flies in the face of the idea of tariffs. I don't know. I suppose there's the national security or the fairness argument, but it was also to reduce the deficit. But
yeah, I mean, a lot of you do hear arguments, regardless of how economically grounded they are, that the tariffs can be used to pay down the debt.
Right. Okay. So that's what I'm saying. So if we take that portion of it, but then you put it the bill that creates yet more debt. It's like, well, what are we doing? I don't think we're going to get the 10-year to go lower.
And what about, Ophir, you talk to a lot of CEOs, you listen in on earnings calls, you're in touch with a lot of businesses. Are they saying anything yet about this and what they think the effects might be?
They are entirely focused, as of the most recent calls, on trade and tariffs, and they don't even want to start talking about a bill which may not ever become law. If you think the populace is exhausted from COVID and then this, CEOs are just, first of all, a lot of CEOs I'm talking to are new names because old CEOs are gone. But they're fully 100% focused on it has business slowed, because in guidance, they're kind of assuming it. They're not sure. It's like things could be really bad, but it could not be really bad. So we're just going to give guidance for the full year as March finished. How did March finish? March was good, and then it was bad, and then it wasn't linear, and so we're not really sure. It's well, then, okay. So what how does beginning of April go? Beginning of April was kind of like the end of March, but also the beginning of also the beginning and middle of March, and then it was linear, but it wasn't linear, and are big projects being put off? I mean, they are, but they're also not. And then AI spending is happening. Is AI spending getting slowed down? It is, but it also isn't. It's okay. All right, it's just it's been like this for 4 years for me with CEOs with other things, where it's I think I told you that one time I talked to a CEO. I said, how do you feel about guidance for the next quarter? He's we can't see 3 months ahead. And this is before tariffs. And I said, then the next guy I talked to, he's we can't see a month ahead. I'm okay, well, that's not very good. And the guy, he's just straight up, he's we can't see a week ahead. I'm okay, well, if you can't see a week ahead, then I can't see a week ahead. So I don't even really know what value I'm adding anymore. So it's gotten to that, but now it's with regard to trade. So that they don't even, if I bring up the bill, they're just honestly, the look on their faces really? That you're gonna ask me about that now? So
what about is AI telling you anything, Ophir? You were so gung ho on that.
Yeah.
On our last
I actually have, with some more research, not that anyone necessarily cares on this podcast, but I have found some really damaging things in AI, which I did not think I would.
Damaging things in AI.
Mm-hmm, yeah.
The models are giving you bad things.
Yeah, it didn't do what they said it did.
I could have told you that.
Yeah, no, I was wrong. I was wrong. It will work for computer science and for some other things, but
yes, after you spoke so vociferously, I said I'm going to try and give another shot. I even went to ChatGPT. I was using the one you suggested, and I keep trying to get it to do like highly technical things for me in market structure, for example, and it keeps just making stuff up.
Oh, I don't have
Constantly.
that. The hallucinations, I don't have it. There is something in the programming that was done to increase. I mean, this is gonna sound, you're gonna think I'm talking about social media, to increase engagement. That part of the optimization, if you're talking about very, very serious topics that are not programming, have insidious impacts on the output it gives you based on its perception of what will keep you going. And it can be really damaging. I think it can be so damaging that people could die. That's how bad I think it could be. Not stable people, but people who are not stable. Or let's say people who are stable but are in an unstable situation. And I really, really pressed that really, really hard the last few months. I just pressed as hard as I could. Same software, different persona. Like I had this personality and I had this personality. Very clear that my goals were this on one side and the opposite on the other. And then I played them against each other. I gave them the answers that the other ones were giving. So each window thought that this was my comment, but it was actually the comment of the same model. And the results are just fucking insidious. It cannot claim that it's wrong. It can't do it. It can't do it. And that is very problematic if you extrapolate that to something beyond someone dumb like me trying to see what would happen if I had them argue. That's fucking insidious. That's really, really, really dangerous because it's not obvious chat by chat, answer by answer that there's this sort of cycle of of reinforcement of its own beliefs.
Not only is that not obvious, but we're here talking macro, there is this macro effect happening of those who rely too much on generative AI, whose critical thinking capabilities are being diminished, who are more prone to simply believe what they're being told from these models.
That's also true, and there is you do develop a skills gap. Like I'm not as good of a programmer as I was 6 months ago. I'm not. I'm not. And that's just starting. But like, there's a real it's not. They're wrong. Apple was right. I can't believe it. Apple was right. It's not reasoning. It isn't reasoning. They're right. If I had saw that article 3 weeks before, I'd be like, Apple's just behind. They're scared. No, Apple's right. That's exactly what I was finding. It's not reasoning. It isn't reasoning. That's wrong.
Okay, so we're running up against it. We're gonna cut it off here. It's a fascinating topic and one that I could see us devoting a whole episode or series of episodes on. I'm actually, I don't know if you guys know this. I don't really talk about it much, but I'm on the editorial board for Springer Journal, the Journal of AI and Ethics, and we're working on an AI ethics handbook right now. That I think would be super interesting, and maybe that would be another great time to have a conversation about these issues. But as always, thank you both so much for joining us. Fascinating conversation. Got lots of great comments and lots of people tuned in. So hopefully all of you listening found this interesting and helpful, informative as well. And we will look forward to the next time. In a couple of months, when another 10 years of headlines will have passed, we'll have all sorts of new stuff to talk about. So thanks again, Ophir and Claudia.
Great. Thank you.
All right. Thanks, everyone, for listening, and we'll see you next time.